Hello, good afternoon, or depending on where you're watching this in the world, good evening or good morning. Welcome to the first of Watson Farley & Williams' global maritime webinars. For those of you who don't know who I am, I'm Patrick Smith. I'm a partner in the assets finance team here in London, and I'll be joined today by my fellow partner, Maren Brandes.
Hello.
And hi, Maren. And we are both based here in London, working in the assets and structured finance team at WFW, specializing in maritime finance. I principally act for owners on financing arrangements, so loans, leases, JOLCOs, etc., but also do work for lenders and sustainable leasing funds. Maren, you predominantly act for lenders, I understand, correct?
That's right.
Yeah. We are also delighted to be joined today by Christian Fjell. He is Director of Sustainability for Shuttles and FSOs at Altera Infrastructure. This is the first of our webinar series, and today's title is ESG, Challenges and Opportunities in Maritime Finance Transactions. We also have a webinar across the Atlantic next Wednesday in our New York office at 9:30 New York time, and there our New York partners, Steve Hollander, Philana Silberberg, and Will Vogel, will be talking about navigating the US capital markets and shipping, trends, challenges, and opportunities. They will be joined by Anthony Argiopoulos, founder of Seabourn Capital Advisors, Thomas Lister, Chief Commercial Officer and Head of ESG at Global Ship Lease, and Ted Young, Chief Financial Officer at Dorian LPG. We also have a further webinar planned for later in the year where we'll cross the Pacific and our Singapore office will talk about solutions or snake oil, the role of technology in reducing shipping emissions. Back to today's topic, and ESG and challenges and opportunities for ship owners. So since the adoption of the Paris Agreement in November 2016 and the publication of the UN Sustainable Development Goals in 2015, we have seen a growing focus on sustainability issues across the shipping industry. Sorry, we seem to have skipped on a slide. Can we go back one, please? Thank you. This has been backed up by the IMO adopting a strategy to achieve 50% reductions in emissions from 2008 levels by 2050. And we've also seen initiatives such as the Poseidon Principles, which we at Watson Farley & Williams have been very proud to have advised on, that came in 2019. This now includes 35 leading banks as signatories, many of whom are also part of the Net Zero Banking Alliance, which was launched in April 2021. And this includes over 140 banks who are aiming to transition to net zero emissions by 2050. And many of those have ambitious interim targets to achieve by 2030. We have also seen EU regulations coming in with regard to the taxonomy and classification of sustainable and green financings, and also reporting requirements for larger or listed EU entities or those which may have significant trade within the EU. This, as well as the coming into effect of MARPOL's Annex 6, means that there's a much greater emphasis on reporting. And in fact, we're soon to see the CII ratings, the Carbon Intensity Indicator ratings, published in April for last year, 2023. The combination of all these reporting requirements and the banks looking at their sustainability requirements and their portfolios and how they're balanced against their targets of achieving net zero by 2050 has put quite a focus on the shipping industry and the need for either green or sustainability-linked financing. We are very pleased to have worked on a number of these transactions ourselves. For example, I've been working with Christian and the Altera team, of course, but we've also worked for Navigator Gas and other owners on some of these financing. In addition, we've seen these being reported in the wider shipping media. I think many people will have seen the recent gas log deal at a 2.8 billion fleet refinancing, and that particularly stood out in the market. In the next 45 minutes or so, Maren and I will give a brief introduction to some of the theory behind sustainable financing, before we then move on to discussing practical experience with our guests. If we have time, we will then have a short Q&A session at the end, and may also look at some other issues that we are seeing, which are arising as the increased focus on regulation by the banks and also for owners. So Maren, I'll hand over to you now to start with the theory.
Thank you very much, Patrick. So if we could move to the next slide, Sophie, thank you. The sustainable loans versus the green loans, what's the difference is our question here. That's going to be answered shortly. I would just add up front that these are all established principles that you can see on the website of the Loan Market Association. So we're basically presenting to you what you can find there, but we thought it would be useful to have a short overview before we get into the discussion with Christian. So green loans are for a specific project, for example, to build a vessel with a green element. One example I have is that I acted on a financing for Hapag-Lloyd. Well, it was a financing led by KfW IPEX and BNP Paribas for a fleet of several ships that are dual fuel ready. And that was a green project and certified as a green project by the Classification Society because of the new technology used for these ships. You have 4 core components for green loans. One is the use of proceeds. The other is the process for evaluation and selection that refers to, for example, environmental sustainability objectives of the eligible green projects and of governance processes. The third one is the management of proceeds, including the tracking of how the proceeds were used. And the last one is the reporting. There's also a review element in the structure, either an external review or, where appropriate, a self-certification. The proceeds must be specifically used for that green project. In case of the ship with specific technology, of course, that's not so difficult. And also it's not so difficult to track the proceeds and the use because you just pay out at delivery. So if you look at the green loan principles that were published by the LMA and others, the categories you get there that would be considered green include categories that foster a net zero emissions economy, protect and restore the environment, facilitate the adaptation to climate change, or provide other environmental benefits. Now, green loans, as the name suggests, are only about the E in ESG. However, there are also social loan principles for projects that directly aim to address or mitigate a specific social issue or seek to achieve positive social outcomes that can also include for outcomes for a particular target population. Now, sustainability-linked finance, in contrast, is meant for wider purposes. There is no link how you use the proceeds and no requirement. So very often the use of proceeds will be for general corporate purposes or even to fund projects that are as yet not specifically identified. If you look at the guidance, the sustainability-linked finance is not related to specific, is linked to achieving ambitious material and quantifiable predetermined sustainability performance objectives. So that is in relation to the group strategy of a borrower, because sustainability-linked loans are meant to support a borrower in improving its sustainability performance. They are a transition tool, and usually the assumption is that the borrower already has an existing strategy. So the borrower here is in the driver's seat and comes to the bank with a strategy, ideally. So according to the guidance on the sustainability-linked loan principles, borrowers that have integrated their sustainability strategy into their business strategy and are therefore already advancing on their ESG journey will often be better able to evidence that their chosen KPIs and SPTs and we come to those in a minute, meet the requirements set out in the principles. Now, what is an ambitious objective? That is a relative term. The ambition is in relation to the particular borrower and the market segment, and possibly the geography and many other factors, and also in relation to where the borrower is in its trajectory to achieving its sustainable targets. What is ambitious for one may not be ambitious for another. Now, unlike the green loans, sustainability-linked loans can refer to all of E and S and G and also combination. Now, our partner Emily Widdrington acted for Navigator Holdings in a loan facility, which may have been the first of its kind, where there was a target for women in senior leadership roles. And the Gaslock facility that Patrick just mentioned also had a KPI that was to increase the percentage of female cadets on its fleet cadetship program. So there are two examples of loans that also had the E, but also had a target in promoting women in the workspace. We get to the next slide. It's getting even more technical now. Thank you. These are the 5 components that are set out in the sustainability-linked loan principles published by the LMA, Loan Market Association. So the KPIs must be material to the borrower's core sustainability and business strategy and address relevant ESG challenges in its industry sector. So relevant core material, material to business, but material can also mean material in its environmental impact or other impact. And they have to be of high strategic significance to the borrower's current or future operations. So they must be core of what the borrower is doing. They must be measurable, quantifiable. They must be able to be benchmarked, for example, against past performance. Even better, however, according to the loan principles, would be a benchmarking against an external reference, such as an applicable industry standard or industry peers. The definition of the KPIs should also include the baseline that is benchmarked against and the applicable scope and calculation methodology. The next element are the SPTs, many abbreviations today. The calibration of the targets is key to the ambition of the loan. So they have to constitute a material improvement and not just business as usual, be compared to a benchmark or an external reference. And ideally, the benchmark should be really a combination of benchmarking approaches. And that should also include the borrower's own performance for the past 3 years. They must be consistent with the borrower strategy, have a predetermined timeline. That means the targets must be set to kick in before or with the origination of the loan, and not afterwards. The recommendation is that an annual SPT should be set per KPI for each year of the loan term. The SPTs should be set to recent performance levels. There is also a recommendation that either the borrower seeks input from an external reviewer to assess the KPIs and their relevance, robustness, and reliability, and also to assess the proposed SPTs, the targets, what's the rationale and the level of ambition for those, and also to assess the relevant benchmarks. And if an external reviewer is not used for that exercise, the alternative would be that the borrower should demonstrate to the lender its initial expertise or a way to achieving that expertise in verifying its methodologies. We then come to the loan characteristics, which basically link the performance or non-performance of the SPTs to an economic outcome. For example, that the margin will be reduced if a certain target is met. And for this purpose, the lender will need to rely on the reporting from the borrower, which should be at least once per year. with up-to-date information to enable the lender to monitor the performance of the SPTs and also to keep track whether the SPTs remain ambitious and relevant. The borrower will also need to provide a sustainability confirmation statement with a verification report attached. The verification should come from a qualified auditor or another expert. Examples given by the LMA for other experts are an environmental consultant or an independent ratings agency, but of course, another example that comes to mind would be the classification society or a classification society. The verification report must outline the performance against the SPTs for the relevant period and the related impact. In the sustainability-linked loan principles, there is a suggestion that borrowers may want to engage a reviewer pre-signing to have an external opinion or an assessment of the KPIs and SPTs to assess the meaningfulness and credibility and ambition of the selected targets. And I would submit that depends on whether the relevant borrowers have a fully formulated strategy yet. The LMA have published draft sustainability loan clauses and guidance on how these should be implemented. And Patrick will take on that slide now.
Thank you, Maren. If we can have the next slide, please, Sophie. Oh, thank you. So yes, as Maren said, the LMA have published sort of draft clauses for sustainability-linked margin adjustments and sustainability-linked performance indicators. LMA obviously is not maritime specifically focused. It looks at a variety of transactions in the general London banking market. So these provisions do need adapting to fit into shipping deals and shipping transactions. But broad outline of the clauses is obviously the main focus and the one that I'm sure most owners would be interested in is the margin adjustment clause. So what does it actually mean for the owners if we have a sustainability-linked loan? We've talked a bit about some of the sustainability performance targets and how they would need to be satisfied in order to trigger a margin adjustment. The LMA provisions have quite a complicated system of sort of maybe sort of 4 different SPTs that could be met, and then a variety of combinations of those may lead to a differing margin adjustment. I think from our experience, what we've seen is it tends to be a little bit more straightforward in shipping transactions, but we may have a factor of 1 or 2 SPTs being combined to produce that final margin adjustment. So Maren mentioned, for example, the Navigator Holdings facility, and there was a target to have women in senior leadership roles, and it was moving sort of from 22% by end 23 to 35% by end 2028. And that formed a separate part of the margin adjustment. So if that criteria was met, they would receive that element of the margin adjustment. In the sort of public gas log loan that we've seen, the margin adjustment there is there's 2 different factors. One of which is the having more cadets, female cadets, and if that's one or both of those things, then it's a much more sort of binary adjustment principle that we see. So you can slice and dice it how you want to sort of either have separate elements that each add an incremental part of the margin adjustment, or maybe combine 1 or 2 different factors, and that either applies to all or some of the adjustments. It's important to bear in mind that it's not a cumulative year-on-year adjustment. So you have a baseline margin, and it will be a ratchet either up or down from that. But the ratchet could increase over time depending on how ambitious the targets are. If you haven't met the SPTs, then there's usually some form of, maybe penalty is the wrong word, but some sort of disincentive to that, so that it would be that the negative adjustment would apply, or maybe there's no adjustment at all. And again, because this is all based on data looking backward at the previous year, very often for for a lot of these factors, then there's a sort of lag between when you do your reporting and when the margin adjustment will come into effect. So you'll have to have a build in a time period for the actual testing period to take place, another time period for the reporting period to occur and it to be verified, and then the compliance certificate produced. And then there'll be a delay before the next interest period can then take effect with the margin adjustment. And then from then on, the margin adjustment should happen on a yearly basis, depending on what sort of reference periods you're looking at. There's various other provisions in the LMA clauses, sort of mechanics to go along with making sure these SPTs are monitored, updated, that the borrower is providing the relevant information and certificates and making reps about that. However, I think it's important to note that the way the LMA approach it is that if these provisions are not met and the borrower is not maybe providing all of the information or can't provide the information, that doesn't necessarily trigger an event of default, which would have serious consequences under the loan, but it may just lead to a loss of the sustainability status, which would obviously have a negative impact for the borrower, but it's maybe not quite as critical to the loan as an event of default being triggered. If that sustainability status is lost, then there may be provisions about re-implementing that, but it could just be a sort of one strike and you're out and you lose the sustainability element of the financing. There's also other provisions in there about publicity. The lenders are very, whilst they may be keen to want to report on having sustainable financings, and I'm sure the borrowers will be very keen to report on the same, the lenders may have their own internal restrictions, which means that they can only report or classify certain loans as being sustainable. So there has to be a provision there to make sure that the reporting is done carefully and done in accordance with that particular lender's guidelines. There would also then be provisions where we may need to amend the sustainability criteria, and we can maybe talk a little bit about that, what sort of amendments we may see, but there needs to be a mechanism there for one of the banks or two or three of the banks to take on the role of sustainability coordinator and to discuss with the borrower the criteria and also what amendments may be needed if they change. And then very often we see the actual KPIs themselves set out as scheduled at the back because they can be quite complicated. I think having discussed the theory, we maybe just like to just test the audience's perception of sustainable financing. So if we can move on to the next slide, please, Sophie. Thank you. And we were just going to run a couple of very quick polls. We know we have both owner and banking clients watching the webinar. It would be nice if maybe the owners only could answer because the lenders may have a different view, but we'll see how we get on with that. So we had two questions we want to ask. The first one is, have any of the owner participants entered into, or would you consider entering into a sustainability linked loan? And I think based on what you've heard already, I mean, if you've already done it, then please say so. If you're considering it, then again, let us know. Or if you're not thinking about it at all or don't know what is involved, then yeah, please also let us know. So please pick one of the options you should see on screen now and do let us know how you feel about sustainable financing. Yeah. Okay, but it's good that looking at those results, so about half of you are considering it, which is good. But only a few of you have actually entered into these loans. I see not very many people are voting, but maybe they'll vote more on the next question. But it's good to see that people are sort of considering it or have already done it.
Nobody's saying they don't know about them, which is great.
I think that's great. I think obviously we've done such a good job of explaining them, Maren, that nobody needs to pick that option. So that's quite good. We'll maybe move on to the next question, and this may get more votes, hopefully, in terms of if you were looking at a sustainability linked loan, what would you consider to be the minimum margin ratchet as an incentive. So this is in basis points. What kind of ratchet would you be looking at to encourage you to enter into a sustainability-linked loan? And the ratchet goes, it's a positive or negative, so it would be, you know, plus or minus each of these figures. Still the same people voting. And as expected, everyone went for 10 or more basis points. But actually, there's quite a
13 is quite a big number
spread
for below 2.5. Yeah.
Yeah. So I think
Interesting.
It's interesting to see, because I was actually, I think before we ran this poll, I was expecting everyone to say nothing for less than 2.5. So I'm very pleased that there's people out there, unless it's the bankers voting, that people would do it for, you know, 2.5 to 5 basis points or more. Well, thank you very much for participating in those polls. I think now we will move on to talking to someone who we definitely know has been involved with sustainability-linked financing, and that's Fjell, and he's Director of Sustainability for Shuttles and FSOs at Altera Infrastructure. Christian, I know Altera very well, but maybe you could just please introduce Altera and yourself briefly to the audience.
Certainly. Thank you so much for having me in this event. I'm really happy to get the opportunity to talk about our experiences on the sustainability-linked loan that we just had last year. So my name is Fjell, Director of Sustainability. I have a technical naval architect background, having worked in the industry for some 17 years, and 13 of those in the current company, which changed name from TK Offshore to Altera Infrastructure in 2020. But we're still the same people, the same assets, and the same crews. So it is shuttle tankers and FSO storage vessels that we're operating in the business unit where I reside. Here I have the responsibility of sustainability, which is spanning across from operations to make sure that we do the sustainable choices in operation, to projects and new builds, to make sure that things are future-proof, that we are wanting to build and realize in the future, but more and more also working directly towards the finance department and the treasury department in relation to loans and stakeholder management on the financing side. Because as you alluded to earlier, reporting on these matters is becoming increasingly important. So in a nutshell, that is me and us, and I'm looking forward to our chat, Patrick.
Thank you, Christian. Thank you. Yeah, so I think let's dive straight in. I mean, so we talked about there was various metrics that you could use for sustainability-linked loans. I mean, which ones have Altera been using?
Yeah, that's a good point, because sustainability encompasses, of course, well, basically almost everything. But we have E, S, and G in the ESG. And for us in the industry that we are in, we are transporting crude oil. There's no way to hide that. Our industry is under strict scrutiny, both with the activities that we do, but also the industry as a whole. So we have to do our part in demonstrating that the actual activities that we can influence are done in an as sustainable matter as we can, and there is the climate aspect is the most important, that we reduce the climate impact, and therefore the carbon intensity indicator, or what was formerly known as the annual efficiency ratio, AER, is the metric that is kind of governing regulations and everything, and other reporting regimes. You mentioned Poseidon principles and others. So we selected that as being the most relevant metric for us to evaluate ourselves against in this matter.
Okay. And were you tempted by any other metrics or?
No, not really. And the reason for that is that the push is so much on climate change and to decarbonize. we are a very heavily regulated industry. I think that's actually quite under communicated how regulated the maritime industry is with the IMO that you mentioned, and it's all about reducing the climate impact. We of course could have on safety and social aspects, but that's a ticket to trade already for us. We have to have impeccable safety standards. Of course, we have a huge challenge in the maritime industry on gender diversity. That's an enormous task, and that could maybe have been a target that could have been included. However, we see that the focus from our customers and from society at large and from regulators is all about the emissions. So we simply prioritize that as it's the most material sustainability topic for us in this time and age.
Yes, and I suppose actually, I mean, I know you already have women in senior leadership positions, as in fact do we, and it might be then hard to find an ambitious, sort of KPI to then or target to then move on from that as well.
But what would have been an interesting target is to improve the gender diversity on board our ships. We are on the seafarers now, we have 1% female, and it's so low that I'm almost embarrassed to say it, but it is a very, very male-oriented industry, and maybe that could be something for the future too, because that's something that I'm passionate about, is to increase and improve. But we have to pick one battle at a time, and for this sake here, it was the climate aspect that we chose to focus on.
Yeah, no, and you mentioned that you're sort of having to comply with a lot of regulations and a lot of reporting standards. How has that sort of fitted into doing a sustainable financing for you? Has it involved a lot more work?
Yeah, so we have and through IMO we have reported on this AER since 2019, and that's really interesting because we are being in the sustainability space. We're being in interaction with consultants and advisors all the time for us to comply with sustainability reporting and so on. And very often when we have consultants or even the auditors from the big three even, that the individuals themselves may not have been too exposed to the shipping industry, they are all actually quite amazed at how much reporting we have done, and even more so than many other industries. So when we can demonstrate that we have third-party verified emissions figures and transport sail distance figures through the IMO DCS, the regime since 2019, they get very surprised by that, pleasantly surprised. But that shows that we already have a very regulated process in place in how to report individually on each ship and have actual certification and statement of compliance being issued by, in our case, the recognized organization being the Classification Society. So we have certified emissions on each individual asset, and that's a major benefit for us. And that's why we wanted to use that as the metric also in the sustainability linked loan, because then we didn't have to invent something new or do something else. We can piggyback on processes that are already in place.
Yeah, no, that sounds interesting. That you're already getting verified information. So actually, from a ship owner's point of view, it doesn't necessarily involve having to get lots more. If you're already doing that and getting that information, it doesn't involve more work for you. That's very interesting and good to hear actually, that it's not costing you more to do that from that target. You said that you're linking your sustainability financing to emissions, and I mean we touched briefly on the Poseidon principles. How are the two sort of marrying up? Can you just take?
Yeah.
Is it the same case? Can you just take the Poseidon principles thing that you're doing
Absolutely.
and use that sustainability, or?
So to begin with, it was harmonized very well that Poseidon principles was using the same metric as the IMO metric, the AER. However, Poseidon principles were stretching further, wanting to achieve a net zero by 2050, whereby at that time when Poseidon principles was launched, IMO only had, I believe it was 70% reduction by 2050. So using the same metric, but with stricter targets was basically how the Poseidon principles were laid out to begin with. But both in the IMO space and in the Poseidon space, we as a group or our assets, the shuttle tankers, are compared against all other tankers. And we're in a niche market. There are only some 70 shuttle tankers in the world, 70, 80 shuttle tankers in the world. But I've heard that there are some 5,000 tankers in the world. And you can imagine that a Suezmax tanker transporting oil from, let's say, Saudi Arabia to Australia has an enormously long voyage. But our shuttle tankers, having the same size as that same tanker, but doing very frequent small short haul distances from an offshore installation to a terminal, let's say in Northern Europe, that means that we are not generating as much transport nautical miles as the deep sea traded tanker. Therefore, in the CII and the AER formula, where you have the grams of CO2 emitted above the fraction line, and then you have the deadweight ton and nautical miles sailed on the below, we don't have that many nautical miles. That means that we are right away, we saw that our CII or AER ratings were double that of conventional tankers. And we were starting to get quite a few questions from the banks on this, that they were seeing in their portfolio that the shuttle tankers are sticking out like sore thumbs in their portfolio, and getting questions, why is this? And then we had to explain that it is because we are compared against the baseline of all the other deep sea tankers in the world. But that led us as an industry to work towards the regulators, IMO in this case. And we were able, through Intertanko, we did this, we were able to come up with proposal for a correction factor for shuttle tankers. So that instead of us comparing it against all other tankers, we were establishing our own baseline for shuttle tankers only. Now that was applied, and which essentially means that the CII rating of a conventional tanker and the same size of a shuttle tanker, we can almost half the CII target. Now, that we have been in discussion with the Secretariat of the Poseidon Principle that we hope, and we also think that the Poseidon Principles will adjust to this IMO correction factor so that it's comparing equally and do not get the unfavorable treatment the shuttle tankers as the others. But it's not happened yet, so that's why we still get these questions from some of the banks at least. But most of the banks now, part of the Poseidon Principle that we are engaging with a lot, we have a close relations with them, so they have an understanding why it is like this. But it's a fair point that we hope and think that these will be merged, and now, since also the trajectory and the target of IMO has been aligned with the net zero in 2050, that is also another argument, hopefully, that the Poseidon Principle will be aligned with the IMO pathway.
Thank you. So yeah, we're maybe expecting some changes down the line, but it doesn't quite fit perfectly at the moment. And what are the benefits that you've seen as an owner in terms of having sustainability linked loans?
It's of course it's a somewhat from a reputation marketing perspective, it's positive. However, there are limitations in the loan agreement as to how you can market it. But I think for us, it is on a personal note, actually. Me being the sustainability director, it gives me more leverage also internally to point to this to the sustainability linked loan that we have to improve, even though actually our CII results and our fleet is significantly lower than the industry benchmark. So we are already in a very, very good space. And if one could be cynical in the organization, say we're so far below the line, so why should we strive to be even better than what is required of us? Then this gives me a little bit of push that, yeah, we have the vision that we have the sustainability linked loan, we have obliged ourselves to improve the results even more in order to get these targets. It's and that's a very strong point that I can use in the operations department and projects and everything, because let's face it, in large organization, you have people are steering towards maybe the fiscal KPIs, the annual KPIs, and very often that's the annual budget. But an annual budget may need to suffer somewhat if you are going to do a capex investment on an energy efficiency installment that you're getting returns on over a longer period of time. So you come into these kinds of interesting discussions, and I'm really seeing this is softening up and it making it more easy now with the likes of this sustainability linked loan argumentation.
Yeah, no, that's interesting to hear. It's kind of giving you hopefully a carrot, maybe not a stick, to use internally, to sort of push your own efficiency. Just thinking about that, I mean, was it difficult to? You say you're already doing a lot. Was it quite difficult to get ambitious targets to meet the sustainability principles?
Yes, difficult. So we had very good discussions with what's it called, the sustainability coordinator. So one of the lenders acting as the sustainability. I forgot the term right now.
Yeah, sustainability coordinator.
Yeah, exactly. So we had, you could almost call it a negotiation to go back and forth on what is the targets that we should set, and they need to be ambitious enough. So that was an interesting exercise, but I think we landed on something that we are quite comfortable with, on both sides, and in particular seeing that we are already doing very well towards the pathway of net zero in 2050. So as long as we can demonstrate a year-on-year improvement, we should be in a good space. And we even saw that the first year, we knew that we would have a lot of dry dockings, basically making the vessels come out with clean hulls and clean propellers. So we even were able to say that in that year, we have even a more ambitious target, but then we're taking it down a notch the subsequent years, but still with year-on-year reductions. So that was quite, and it was a constructive and good discussion.
Good. It's good to hear that. Sort of, again, it's a relationship thing, isn't it? I suppose you need to have the dialogue with your banks, and you need the banks to know what they're talking about as well, so that you can set ambitious targets. And do you think the incentives, margin ratchets, for example, are they enough to drive change, or do you think more?
I think, of course, we would always want it to be even more, but recognizing also that it has to make financially sense from the lenders, of course, as well. So that's always a balance. So I would say that this in itself doesn't justify me advocating for installation of wind-assisted propulsion equipment or something like that. It would need to be in combination with this, in combination with strict regulations on emissions, and hopefully also in combination with acceptance from our charterers to take part of the bill. We're in a side of the industry where the charterers are paying for the fuel, and therefore also getting the monetary benefit of the energy efficiencies that we would gain. So I think a trifecta of favorable financing costs, stricter regulations stimulating this, and charter acceptance, also willingness to pay for the subsequent savings that they would get. That is what is needed in order to really uptake this decarbonization in our industry space. And this is different for other industry sectors, other shipping sectors, but for us, this is really, really important.
And I suppose it's a little bit of an elephant in the room, and I know you've touched upon it previously as well. As you say, you are a tanker company, and your business is shipping crude oil. There may be some people thinking, well, how can you have a sustainability-linked loan where the underlying business is so carbon intensive?
Yeah.
Are there accusations of greenwashing with the sustainability linked loan?
I've not been directly accused of that in any sense, but it's something that we are of course sensitive to. And of course industry groups or NGOs and others out there would certainly mean that. So that is something we take very seriously. But our position is that transport of energy and oil and gas is required in decades to come. And the energy crisis that we saw in 2022 certainly is a testament to that. And actually, coincidentally, living in Stavanger, which is basically the oil capital of Norway, years before that, we were a little bit, well, back in the heydays, it was the place to be in Norway. And then suddenly it was almost like the oil industry was untouchable. And then came the energy crisis, and then suddenly oil industry and gas and gas supply to Europe and everything. And then we got a boost again in public opinion. But that set that aside. We are transporting oil that will eventually be produced and used for other means. But the carbon intensity of doing that is very high. And we had one very interesting or very fun, actually, experience last year where one of our captains was instructed to sail at charter party speed from an oil terminal or offshore installation to an oil terminal, only to be informed by the oil terminal that the berthing space wasn't available at that time. So the captain then went back to the chartering desk asking if we can seek permission from all of the stakeholders of the cargo to go at reduced speed. Sometimes you can, sometimes you can't because of commercial constraints and the transfer of ownership of the cargo and so on. But in this instance, we got approval from all of the cargo stakeholders that he could, instead of going at the normal agreed charter party speed, go at reduced speed. And then instead of going 13 knots, he only went about 8 knots over 1.5 days approximately, but that saved 27 tons of fuel. Now, 27 tons of fuel is an abstract figure, but if you just think about how much fuel a normal diesel car uses per year, you could actually travel a normal diesel car 15.5 times around the equator with that 27 tons. So it just shows a bit the scale of potential there is in our industry to reduce emissions in everything that we do. So I think that's why it's important that actors like us as well are improving the carbon intensity. So we will never go out and claim that we're going to save the world on climate on this aspect, but we can at least reduce the part that we are. And on a side note to that, we recognize that there is an energy transition, and that's why our company is investing heavily into what we call new ventures, and in particular a carbon capture and storage infrastructure. So more to be talked about that maybe at a later stage. So we have to stand on both legs, and so yeah.
Yeah, no, I completely take the point. I think it's, it might be a small change, but the small changes actually do have a big impact.
Yeah.
And and I think lots and lots of small changes added together would have an even greater impact. That's a really interesting example, actually. It's incredible to think you could save so much fuel in such a short time by a relatively small change.
Just every little helps, yes, to quote somebody else, yes. Yeah. But is it really burdensome for you then to, if we go back to what you said initially, that you've been reporting since 2019 on the AER, and you've got all these regulations becoming tighter and maybe too ambitious for you or not ambitious enough for you? That's for you to say. Can you give us a bit of a taste how it actually works in practice?
Yeah.
Because we got a provision that says this needs to be done. So that's our theory. What's your practice?
Yes, absolutely. And 2018, 19, and that phase, that's when all of these regulations were coming in, IMO and the EU MRV as well to report in the EU. And then you had the Poseidon principles coming, and then you had the Sea Cargo Charter for the charterers, and then you have the insurance companies having a similar metrics. So we were very overwhelmed with reporting regimes in that period. And that also made us a little bit allergic to taking on new additional reporting regimes. But I think we're reaping a bit the benefits of that now in this instance where we can just, and that was part of the negotiation as well with the lenders in our financing case here, is that we were able to demonstrate and show that, okay, on each individual ship, we have the document of compliance or a certificate of compliance from DNV. We will provide you with that. And so you have third-party verified emissions figure. And then to transfer that into a fleet carbon intensity indicator, there is, in a regulatory space, there is no such thing as a fleet carbon intensity indicator. But we were very much inspired by the work that has already been done in the past by, for instance, I want to mention Fjell, the chemical carrier based out of Bergen. We have close relationship with Fjell and have many crossing points in different industry forums. And we looked very much to the sustainability linked, I think it was a bond that they had. So there's this sustainability linked bond framework, or perhaps it was a loan.
I think it was a bond, Christian.
Yeah. On how they went about in calculating a fleet CII. And we just thought that is brilliant and it's very simple. And we handed then that calculation based on the certified emissions figure from each ship to the sustainability coordinator for them to be able to verify just on that very simple calculation. Additionally, we are using that same calculation in our sustainability reporting, and we have done so since 2020. We've included this figure. So therefore, we're reporting on it annually, and we have done so since 2020. We're providing the certified figure to the sustainability coordinator to validate that fairly simple calculation. And we were then able to argue that, well, is there really a need for another third party then to go and validate that fairly simple calculation? And luckily, I would say luckily, that we agreed that no, that didn't make much sense. So that was reduced the burden a lot. So I'm really happy that we were able to just utilize existing work processes so that we don't add on more, because we really, it is a lot of reporting that is going on. And you mentioned that reporting beast of the EU CSRD, the Sustainability Reporting Directive. And just for us to be able to prepare for that, we have spent thousands of internal man hours, and I don't even want to think about how many external man hours, just for us to be able to prepare for that wave of sustainability reporting that is coming. So in the future as well, for instances like this, I think it's very value adding for all parties if we can just rely on existing work processes as much as possible.
Yeah, in fact, it's probably more sustainable to rely on existing work processes. I mean, if you're already doing it, you don't need to get more people in to do that. And are there any other sort of reporting and regulatory sort of challenges that you're facing at the moment as an owner?
Yes, of course, and it's coming more and more. And now we're just about to get our head above water with the EU ETS, so the emissions trading scheme for EU. And there as well, we as a company believe strongly in the emitter pays principle. So we need to pay for the emissions that we have. And that payment must be high enough that it actually incentivizes change. So the way it is now with the EU ETS, with the carbon price of around, I haven't checked in the last weeks, but let's say it's around 60 euros per ton. To be honest, that is probably not enough. It doesn't really incentivize and the big changes, nor can it financially justify a lot of the energy efficiency improvements that we maybe wanted to invest in. So if that were to come up quite a bit, then maybe it'd be another world. But we don't, as a company, we don't like that market-based mechanism with a very fluctuating price. We are very much more in favor of just a global CO2 levy, still at a high enough level that it incentivizes change. But just as an example now to show you, to implement EU ETS, we had to start with lawyers to help us with the clauses.
Very pleased to hear that.
Yeah, exactly.
Yeah,
with the clauses. And then negotiation with customers. Our customers tends to be both small oil companies, but mostly the large oil companies. When we are then negotiating with large companies, you know, the size difference of magnitude. So we then tend to get pushed back on some of the positions that we have. So then you're giving away some flexibility. We had to use IT consultants to set up our systems for calculating this. We had to involve treasury departments in order to establish the credit lines, the links to the trading to purchase quotas. We have you have consultants wanting to advise you on how to organizationally set this up. We have talked to brokers on advising on purchasing strategies and so on. And then you have the whole internal aspects of F&A and financing and accounting of all of this. And it's been a lot of steps in order for us to be in a place that we are now more or less ready. We're not 100% ready with all aspects of it yet. So that is, we're just getting our head above water on that now. And then the next part is the Fuel EU Maritime, which is coming. So I have a big lump in my gut on that, whoa, we haven't even had time to digest the ETS, and now we have to jump on the Fuel EU Maritime as well. And I don't think this is going to be the last thing either. So it's interesting days to be a sustainability lead in a company, that's for sure. Yeah. But we have quite a bit of challenges and opportunities, of course, on this.
Yeah. No, it does sound like you've got a lot of, as an owner, you have so many pressures to comply with regulations and reporting that, you know, you're taking on so much extra. It's actually quite nice that if you can then leverage that and use that to obtain better financing.
Absolutely.
Yeah. I think we may actually now be running a bit short on time, I'm afraid.
Yeah.
It's been a really exciting and interesting discussion.
Just to say a very good comment that the unification of measures will limit the administrative burden of compliance without compromising on the overall principles. Thank you very much for that comment. I think that's true. Yeah, from the Q&A, but we don't really have, yeah, we've run out of time. See.
Which shows it's been a lively discussion. So yes, thank you so much, Christian, for joining us. Thank you everybody for watching and for listening and dialing in. Please do join our webinar next week, next Wednesday. It's 9:30 New York time, and that's on the US capital markets with our New York office and their guests. But until then, I wish you enjoy the rest of your day. Thank you.
Thank you.
Thank you.